Hey everyone! Today we're diving into the fascinating world of the stock market. If you've ever wondered how it works, why it goes up and down, and how you can get started, this video is for you. Let's break it down in simple terms because honestly, it doesn't need to be as complicated as people make it seem. We'll cover the basics like what stocks actually are and why they change in price. Then we'll get into how you can potentially make money in the stock market, both from stock prices going up and from something called dividends. And look, I know what you're thinking, Zolkar, isn't the stock market risky? And yeah, there are definitely risks involved. We'll cover those too. But don't worry, by the end of this video you'll have a solid understanding of how the market works and how you can start investing, even with a small amount of money. So, let's get started. Okay, imagine a giant marketplace, but instead of selling fruits and vegetables, they're selling pieces of companies. That's essentially what the stock market is. These pieces of companies are called stocks, and when you buy a stock, you're buying a tiny slice of ownership in that business. Think about it like this. Let's say you love a local bakery that makes the best donuts in town. You can't stop talking about these donuts and you wish you could share in their success. Well, if they were a publicly traded company, you could buy a share of their stock and actually participate in their growth. Now, there are many stock exchanges around the world, but the big ones you've probably heard of are the New York Stock Exchange, the NYSE, and the NASDAQ. Alright, now let's get to the heart of it. Why do stock prices go up and down like a roller coaster? Well, just like that bakery selling delicious donuts, the stock market is all about supply and demand. If more people want to buy a stock than sell it, meaning there's high demand, the price goes up. It's like those limited edition sneakers everyone wants. The price skyrockets because everyone's trying to get their hands on a pair. On the flip side, if more people are selling a stock than buying it, meaning there's low demand, the price drops. It's like that old sweater you're trying to sell online. You might have to lower the price to find a buyer. But what makes people want to buy or sell in the first place? Well, that's where things get really interesting. A whole bunch of factors can influence stock prices, and these factors can change constantly. Company news is a big one. Let's say that bakery announces they've invented a brand new, super delicious cronut that's selling like crazy. Now let's talk about how you can potentially make money in the stock market. There are two main ways: capital gains and dividends. Capital gains are what most people think of when they think about making money in stocks. It's the classic buy low, sell high strategy. You buy a stock at one price, and if the price goes up, you sell it for a profit. Simple, right? Let's say you buy 100 shares of that bakery stock at $10 per share for a total investment of $1,000. A few years later, the bakery is doing even better than before. They've expanded to multiple locations, and their cronuts are legendary. The stock price has risen to $20 per share. Now, before you go all in on the stock market, we need to talk about the risks. Because yes, investing in stocks does come with risks, and it's important to understand them before you invest your hard-earned money. First and foremost, stock prices can go down, and sometimes they can go down a lot. Remember the 2008 financial crisis or the dot-com bubble burst in the early 2000s? These events remind us that the market doesn't always go up, and sometimes it can take a sharp downturn. But even without a major market crash, individual stocks can experience significant drops in price due to factors like poor management, increased competition, changing consumer preferences, or unforeseen events. There's also the risk that you could invest in a company that goes bankrupt. It doesn't happen often, but it's a possibility, and if it does, you could lose your entire investment. And then there's volatility. Volatility refers to how much and how quickly stock prices move up and down. The stock market can be a roller coaster, with periods of smooth sailing followed by sudden drops and sharp rebounds. Alright, so you're ready to dip your toes into the stock market? Great. Here's a simple roadmap to get you started. First things first, you need to open a brokerage account. Think of a brokerage account like your gateway to the stock market. It's where you'll deposit money, buy and sell stocks, and track your investments. There are tons of brokerage firms out there like Fidelity, Schwab, Vanguard, and Robinhood, each with their own pros and cons. Do your research, compare fees, account minimums, and features to find one that aligns with your needs and investment goals. Once you have a brokerage account set up, it's time to start investing. But hold on, before you go picking individual stocks like you're trying to win the lottery, there's a smarter, more beginner-friendly approach: index funds. Remember the S&P 500 we talked about earlier? Well, with index funds, you can essentially buy a tiny piece of all 500 companies in the S&P 500 with a single investment. It's like buying the entire stock market in one shot, instead of trying to pick individual winners and losers. The stock market can seem complicated, but at its core, it's a powerful way to build wealth over time. Stay patient, stay consistent, and remember, you're buying into real businesses, not just ticker symbols. Thanks for tuning in. If this helped clear things up, share it with a friend, and I'll see you next time for more smart money tips.